Hello and welcome to Business Standards Morning Show. I am Ruchika Chakravanshi and let us take a look at the stories for today. The benchmark indices slid 2% yesterday as a surge in Omicron cases, along with an FPI sell-off in India, troubled investors. As FPI selling may increase due to the year-end factor and with more Western countries exploring stricter measures to stem the spread of coronavirus, equities could remain under pressure in the near term. Let us delve into the strategies that investors could adopt to ride this uncertainty.
Indian benchmarks ended at a 4-month low on Monday as the rapid spread of Omicron COVID-19 variant triggered stricter containment measures across European countries. Back home too, different states continue to report fresh Omicron cases, taking the tally above 150. What also gave ammunition to the bears was the merciless selling by foreign investors, who have sold Indian equities worth over 33,000 crore rupees since October 2021. A weaker rupee, hawkish policy stance by global central banks, and interest rate cut by China amid slowing economic growth too bothered investors. Given this, the BSE Sensex plunged nearly 1,900 points intraday, while the Nifty 50 tested the 16,400 mark to hit their lowest levels since August this year. They eventually settled at 55,822 and 16,614, down 1,190 points and 371 points respectively. Let's go to Business Standards Avadhoot Bakar to know the key levels for the Sensex and Nifty.
The benchmark indices BSE Sensex and Nifty closing gap down, correcting over 2% in a single session. This move has decisively broken the support of 100 EMA, which both the indices were holding from last 15 sessions. Now, the trend suggests a rally towards 54,400 for Sensex and 60,250 for Nifty 50, and these are the 200 EMA levels for both the indices. On the other side, 57,000 and 59,000 are the crucial resistance for Sensex and 17,000 and 17,600 for Nifty 50.
As fundamental and technical concerns show further downside for the markets in the near future, we have with us Vaibhav Sanghvi, co-CEO of Avendus Capital, to suggest how investors should position themselves amid this sell-off.
If you look for a 2 to 3 year horizon, buy the dips would be an apt strategy, because here from a domestic standpoint I don't see any major reasons to worry, especially on the economic growth as well as the earnings potential. Now if those two things are something which kind of change going forward, then we may reconsider it, but as we stand, my sense is basically these are not going away, and probably some good amount of dips should be utilized to kind of take exposures towards the markets. But mind it, I think the volatility will continue. It's not going to be as smoother affair as we have been earlier, as well as the configuration of the sectors and the stocks might also change. So it's going to be a little volatile and tricky, but buy the dip strategy should not be a bad one.
However, if you are afraid to take the plunge in the equities segment, fixed income assets or safe haven like gold can be explored. According to analysts, the end of the calendar year is always a good time to do a thorough check of your financial portfolio, as the holiday season in overseas market always creates a volatile period back home. Here are some steps that investors can take going forward. As mid and small cap funds have far outperformed large cap funds over the past year, it is advisable to rebalance your exposure to these sub-asset classes at current levels. Secondly, looking at global stocks could be a better strategy at this hour, as it can provide investors access to asset classes and themes not easily available in India. Third, With the US Federal Reserve deciding to reduce liquidity at a faster pace and undertake 3 rate hikes in 2022, the high liquidity and low interest rate scenario is set to change. Given this, analysts say sticking to quality stocks will be better as the shares decline less and recover faster. Another option is to increase your allocation in debt funds. With most developed economies back on growth path and inflation being less transient, central banks will gradually reduce adding liquidity and then raise their benchmark rates. Hence, investors should take an allocation to debt funds even though returns may remain in the single digit next year also. Lastly, analysts suggest investors should maintain a 10 to 15% allocation to gold in their portfolio. Overall, a combination of active management, multi-asset strategies, and asset allocation is likely to provide better outcomes in the near term as the period of easy money making across asset classes is over, says S. Narain, Executive Director and Chief Investment Officer at ICICI Prudential AMC. With no major event lined up in the domestic market, CMS Infosystems IPO and global trends will guide the markets on Tuesday.
After a strong run, markets have become volatile towards the end of the year. But for exports, this year has been great. India's goal of clocking $400 billion in merchandise exports now looks more attainable than ever. A depreciating rupee and a continued recovery in global demand is helping India sustain its export momentum. However, the forecast for 2022 is not as certain. Let us look at the factors that are contributing to India's export growth and the major risks that threaten to stall the momentum.
At the beginning of this fiscal, the centre had set a merchandise export target of $400 billion for FY22, which at the time seemed ambitious. After all, our FY21 exports fell 7.3% to $290 billion from $313 billion the previous year. The fall was mainly due to a sharp drop in exports of petroleum products as COVID-19 lockdowns curbed transportation activities and hurt the demand for fuel. Even if we consider FY21 as an oddity due to lockdowns around the world, India's exports put up an impressive show this fiscal. From April to November this year, they are up 51% to $263 billion and set to cross last year's number by December. The rise in India's exports could be attributed largely to the growth momentum in advanced economies and the resultant increase in global import demand. The depreciating rupee has come as a blessing in disguise as it makes Indian goods from labor-intensive sectors like textiles and clothing more competitive globally. India is also aggressively negotiating free trade agreements with the European Union, Australia, the UAE, the UK, and the Gulf Cooperation Council. Any such deals materializing in the next few months will ensure greater access for Indian goods. The recently introduced PLI schemes will also support growth, particularly in mobile, electronics, and pharma sectors, as incremental production will push additional exports as well. Further, the government has introduced export incentive schemes and cleared some pending tax refunds to exporters to improve their liquidity. To give us insight on whether India's export growth can sustain at this rate, we have with us Professor Amita Batra of Jawaharlal Nehru University.
Given the fact that we haven't been aligned with the trends in global trade in the last decade and a half, nor so as far as the pandemic period is concerned, sustainability becomes an important question. There is a question mark as far as sustainability of India's exports is concerned. For the purpose, it is important that India get integrated in global value chains, particularly as far as automobiles and electronics are concerned. Both these are sectors where dynamism continues to exist and is likely to last beyond the pandemic, particularly as far as electronics and office machinery equipment is concerned. These are both sectors that have got a fillip during the pandemic. So if we get integrated in these sectors, that is where sustainable long-term growth can be achieved as far as India's exports is concerned. How do we get into it? One or two, basic measures or basic policy changes that are required. One would be in terms of changes as far or reduction as far as our import tariff structure is concerned, particularly in the electronics industry, where input tariffs have been increased in recent years, and they prove to be counterproductive to both productivity as well as productive investment, attracting productive investment, export-oriented investment in this sector. Two, integration with the value chains in East Asia, which is really the hub of the electronic value chain globally. If we are able to proceed on the lines in terms of reduction of import tariffs on inputs in sectors that are critical as far as global value chains are concerned, leading the global trade growth, then plus if we add to that, signing FTAs or getting ourselves integrated through FTAs with the trade dynamic regions, it would do a lot for sustaining or sustainable growth as far as India's exports in the longer run or even in the medium term post-pandemic is concerned.
Considering all these factors, can the export momentum spill over to the next fiscal? The answer comes with several caveats. Global demand will depend on whether the countries would be able to contain COVID-19 and the new Omicron variant. Another key obstacle is the container shortage and high freight rates. With increasing Indian imports and China's export growth slowing down, the container shortage has eased slightly in India, but freight costs are still nowhere near pre-pandemic times. The average container prices at Chennai and Mumbai ports are still about 150% higher than 2019 levels. Exporters have in fact asked the government for freight support. Further, India Ratings and Research opined that it will not be easy to maintain the current export growth momentum, as the stimulus-induced demand in developed economies might normalize in 2022, and it could tilt back in favor of services. India is doing all it can to provide an impetus to outbound shipments, but things that are out of its control threaten to put brakes on the export party.
Besides exports, another area in which we are hoping to see a pickup in momentum is EVs. Most of us are thrilled with the idea of electric vehicles, but the one question that pops up every time we speak of them is what about the charging of batteries? An answer could be swappable batteries. Very soon, you will be able to refuel your EV's battery at a nearby Kirana store. Your discharged battery would be replaced by a charged one within minutes. Let us take a look at how this battery swapping technology could help catapult the EVs into the mainstream.
In August last year, when the government announced the sale of electric two-wheelers and three-wheelers without factory-fitted battery, industry and consumer alike were left a little perplexed. Fast forward to now, we realize that the government was acting with a forethought. And in October this year, the Union Minister for Road Transport and Highways, Nitin Gadkari, told a conclave that 80% of two-wheelers and 30% of private vehicles will be electric by 2030. Battery price makes up as much as 50% of an electric vehicle's cost. An emerging trend to tackle the problem of high cost of EV adoption is battery swapping technology. Reliance BP Mobility signed an agreement with Mahindra & Mahindra earlier this month, which, among other things, will explore battery swapping. The deal came at a time when two of India's biggest state-owned fuel retailers, Indian Oil and Bharat Petroleum, announced their plans to offer charging stations at 17,000 petrol pumps. But some believe that battery swapping is the better alternative to battery charging for a country like India. The biggest worry for any EV buyer is range anxiety, or the worry that the battery will run out of power before a charging point is reached, and also the time taken in charging them. Battery swapping is designed to eliminate range anxiety, as it is easier to set up a dense network of swapping stations even in urban areas. Not just this, electric charging takes time, and Indian cities do not have the physical space that can accommodate hundreds of vehicles when EVs become mainstream. Swapping addresses that problem too. Bengaluru-based scooter rental startup Bounce has launched an electric scooter without a battery pack that's priced at just Rs 45,000. This model comes with a subscription to the company's battery as a service product. Customers can stop at any battery swapping station in Bounce's network and instantly replace their depleted batteries with fully charged ready-to-go batteries. Bounce co-founder and CEO Vivekananda discussed with us the merits of battery swapping as compared to charging.
People living in apartments can't charge. People who don't have parking space can't charge. With battery swapping, you can remove the battery, carry the battery, and charge it. So that is our first USP. Our scooters come with removable batteries, one. As and when people are comfortable with battery swapping as a network, they don't even have to buy the battery. They can pay for the battery per use, like how they pay for fuel. It's not a very new behavior for people to pay as they go. That is why we are bullish on swapping. No charging issues, no infra issues, no waiting time. Range anxiety goes away, right? It takes under 10 seconds to swap a battery. Your battery swapping point can be your nearby Kirana store, or you can be a neighbor. But talking about charging, the biggest challenge is India doesn't have real estate. So imagine millions of vehicles having to wait, even if it's like 1 minute, right? Forget about 30 minutes, everything. Let's say technology evolved like crazy. Even if they have to wait for 1 minute, the queuing theory kicks in and the amount of space you need is massive. So at scale, when we're talking about EV becoming mainstream, we don't think for two-wheelers charging would work on public charging. Even if it takes under 10 minutes, I think we don't have that kind of real estate in India for there to be enough charging infra. To give you an example, for charging more than 10 scooters in a place, you need a transformer, as in you need additional power capacity. And if you're doing fast charge, you need to 10x the kind of power to fast charge. I think government has to earmark spaces everywhere so that it becomes the mainstream, right? It should say that every apartment should have a public battery swapping access place, like how ATMs are, right? We are building something like ATM, right? In a way. So we should start going out and building that ATM kind of thing, right? Where every mall should have access for this, easy access to park your vehicle, swap and go type, right? We are working with central government on standardization. The idea is that it's the same square feet kind of as in square centimeters. The charging unit is the same so that it can be interoperable. We are already integrated with multiple OEMs so that they can use our batteries. Idea is to build an infra which everyone can use. Battery swapping will overtake and probably be much more mainstream than charging, at least for two-wheelers.
With big players like Reliance Industries, BP and Mahindra moving into this space in India, we can expect standardization to evolve soon. Further, several states including Kerala, Karnataka and Maharashtra are providing incentives and subsidies to set up battery swapping stations. In China and in the US, some companies have already set up automated swapping stations for cars, which is particularly useful for commercial fleet operators. As for Bounce, it is competing with companies like Ather Energy and Ola Electric, both of which depend on charging networks. Bounce's first electric scooter will hence serve as a test case for the promise the battery swapping technology holds. Just like the e-rickshaws, we may see the proliferation of electric scooters and three-wheelers in the days to come, and the battery swapping technology will only make the transition smoother.
Moving on, while some industry experts were disappointed by Centre's U-turn on 3 agriculture laws, farmer unions thought differently. They were cheering when Prime Minister Narendra Modi made the announcement on November 19. Farmers hailed the decision and vacated the protest sites, but only after the government promised to look into another of their demands, to legalize minimum support price or MSP. But what exactly is MSP? How did it come into being in the 1960s? And how is it benefiting farmers now? Let us understand.
MSPs are the prices at which the government procures certain crops from farmers to insure them against any sharp fall in prices. It is an integral component of agriculture price policy, and it strives to ensure support price to farmers and affordable prices to the consumer. Based on the recommendations of the Commission for Agricultural Costs and Prices, the government declares MSP after considering the views of state governments and the concerned central ministries and departments for agricultural crops such as cereals, pulses, oilseeds and commercial crops every year at the beginning of both the crop seasons. The factors considered by CACP for fixing MSP include cost of production, domestic and international prices, demand-supply conditions, intercrop price parity, and the terms of trade between agricultural and non-agricultural sectors. MSP ensures a profit of at least 50% over the cost of production for the farmers. Moreover, if the farmers get favorable terms to sell their produce or better price than MSP, they are free to sell to non-government parties. The concept first began in 1966 with the Green Revolution. Though it is not legally mandated to do so, the government currently announces MSP for 25 major agricultural commodities each year, including 14 crops of the Kharif season and 7 crops of the Rabi season. Apart from this, MSP is announced for copra, dehusked coconut and jute, along with a fair remunerative price for sugarcane. FRP is the minimum price that sugar mills have to pay sugarcane growers. Currently, the government mainly buys rice and wheat at the guaranteed prices. The procured wheat and paddy is utilized in distribution under targeted public distribution system and other welfare schemes under National Food Security Act. 2.1 crore farmers have benefited from the government procurement at MSP in 2020-21 compared to 2.04 crore farmers in the previous year. The centre has procured a record 879 lakh tons of paddy in the 2020-21 marketing season for nearly Rs 1.66 trillion. The MSP for paddy has gone from Rs 1,360 per quintal in 2014-15 to Rs 1,940 per quintal in 2021-22, a 43% increase. Wheat procurement had also hit an all-time high of almost 390 lakh tons with MSP value of Rs 75,000 crore. The MSP for wheat has gone up from Rs 1,450 per quintal in 2014-15 to Rs 2,015 per quintal in 2021-22, indicating a 39% increase. The government says it is committed to continue MSP operations to ensure remunerative prices to the farmers. According to most experts, legalizing MSP will be a bad move if taken. Executive Director of Center for Sustainable Agriculture, G.V. Ramanjaneyulu, recently said that a guaranteed MSP will kill Indian agriculture. He said that if the government provides a legal guarantee to MSP, it will lead to wrong cropping patterns tilted towards high-yielding crops.
The effects of the Green Revolution have long faded. Now the country's agriculture sector is in need of urgent reforms to reduce our dependence on imports and to boost our economy. That's all we have for you today. We will be back with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.